What's up, everybody? It's Pablo, and welcome back to the channel. Today, we're diving deep into the world of financial ratios. These ratios are like cheat codes for investors, giving you a quick and easy way to analyze a company's financial health. Whether you're just starting out or you're a seasoned investor, understanding these ratios is crucial in 2024. Think of it this way. If you're buying a used car, you're going to look under the hood, check the mileage, right? Same thing with stocks. You got to look under the hood at the financials. We're talking about what they mean, why they matter, and how you can use them to your advantage, so buckle up. First up, we've got the price-to-earnings ratio, or PE ratio for short. This ratio tells you how much investors are willing to pay for every dollar of a company's earnings. Let's say you're looking at a company with a PE ratio of 20. That means investors are willing to pay $20 for every $1 of earnings the company generates. A high PE ratio could mean that investors are expecting high growth in the future or that the stock is overvalued. On the flip side, a low PE ratio could indicate that the stock is undervalued or that investors aren't expecting much growth. The PE ratio is just one piece of the puzzle, but it's a critical one to help you understand whether a company is potentially overvalued or undervalued. Next, we've got the debt-to-equity ratio. This ratio measures a company's financial leverage, which tells you how much debt a company is using to finance its assets. A high debt-to-equity ratio means that the company is using a lot of debt, which can be risky. If a company has a ton of debt and their earnings take a hit, they still have to make those interest payments. On the other hand, a low debt-to-equity ratio means that the company is using less debt and is generally considered to be less risky. As a general rule of thumb, a debt-to-equity ratio above 2 is generally considered to be risky. Let's talk about the current ratio. This ratio measures a company's ability to pay off its short-term liabilities with its short-term assets. A current ratio of 1 or higher is generally considered to be healthy, as it means that the company has more current assets than current liabilities. But a current ratio of less than 1 could be a red flag, as it means that the company may have trouble paying its bills if things get tough. The current ratio helps you avoid companies that are constantly struggling to make ends meet. Now, let's move on to return on equity, or ROE. This ratio measures how much profit a company generates with the money shareholders have invested. A high ROE is generally a good thing, as it means that the company is generating a lot of profit with the money you've invested. But a low ROE could indicate that the company is not using its equity efficiently. When you're looking at ROE, it's important to compare it to the industry average. For example, a company in a slow-growing industry might have a lower ROE than a company in a high-growth industry. Up next, we have the price-to-book ratio, or PB ratio. This ratio compares a company's market value to its book value. A PB ratio of less than 1 could indicate that the stock is undervalued, while a PB ratio of more than 1 could suggest that the stock is overvalued. However, keep in mind that the PB ratio can vary widely depending on the industry. For example, technology companies tend to have higher PB ratios than manufacturing companies. So, when you're using the PB ratio, it's essential to compare it to the industry average. Let's talk about dividend yield. This ratio measures the amount of a company's annual dividend payment relative to its stock price. For example, a company with a dividend yield of 4% means that for every $100 you invest, you'll receive $4 in dividends each year. This ratio is particularly important for income-focused investors who are looking for a steady stream of passive income. However, a high dividend yield isn't always a good thing. Sometimes it can be a sign that a company is struggling and may have to cut its dividend in the future. So it's important to look at the company's overall financial health before investing solely based on its dividend yield. Now let's move on to earnings per share, or EPS. This ratio measures a company's profitability on a per-share basis. It's calculated by dividing a company's net income by the number of outstanding shares. Generally, a higher EPS indicates higher profitability and is considered more favorable for investors. However, EPS can be manipulated by factors such as stock buybacks, which reduce the number of outstanding shares and artificially inflate EPS. So it's always crucial to look beyond just the EPS number and consider the company's overall financial health and accounting practices. Next up, we have the quick ratio, also known as the acid test ratio. This ratio is similar to the current ratio, but it provides a more conservative measure of a company's short-term liquidity. The quick ratio excludes inventory from current assets because inventory can be slow to convert to cash. A quick ratio of 1 or higher is generally considered healthy, indicating that the company can meet its short-term obligations without relying on inventory sales. Let's talk about the price-to-sales ratio, or PS ratio. This ratio compares a company's market capitalization to its annual revenue. A high PS ratio could indicate that investors are expecting high revenue growth in the future. Conversely, a low PS ratio might suggest that the company is undervalued or that investors are not expecting much revenue growth. The PS ratio is particularly helpful when comparing companies within the same industry, as it can highlight those with high revenue growth potential or those that might be overvalued based on their current revenue levels. Finally, we have the return on assets, or ROA. This ratio measures how effectively a company utilizes its assets to generate profits. It's calculated by dividing a company's net income by its total assets. A higher ROA generally indicates that the company is utilizing its assets more effectively and generating higher profits. When analyzing ROA, it's essential to compare it to industry averages and historical trends to gain a comprehensive understanding of the company's performance. So, there you have it, the top 10 financial ratios every investor should know. These ratios are essential tools for analyzing a company's financial health and making informed investment decisions. If you want to take your investing to the next level, make sure to hit that like button, subscribe to the channel for more awesome financial content, and check out my blog for even more in-depth information on these ratios and other investing strategies. Thanks for watching, and I'll see you in the next one.